Welcome to the Techno Fundamental Report for February the 12th. Trueflation is something I've become aware of that I think is interesting. Trueflation monitors 35 million prices in real time, scraping data directly while the Bureau of Labor Statistics literally sends out secret shoppers every couple of weeks. They manually count a tiny fraction of the prices measured by Trueflation. Some of the data is a month old by the time it is reported. So you might want to pause your video player and look at some of this data that I provided, but Trueflation is an independent third party that is measuring things that the Federal Reserve and the Department of Labor Statistics should be doing properly. But I do believe that Trueflation is something we should keep an eye on. You know, the Federal Reserve System often considers the largest employer of PhD economists in the United States. They have 400 of these guys. And then Musk has said AI and robotics will create significant deflation within 3 years or less. So the current Trueflation number as of recently is that inflation has gone up by 0.78%, whereas the Bureau of Labor Statistics has it at 2.7%. So the argument I would make here is that maybe the Federal Reserve and the Department of Bureau Statistics is outdated and that we need to do something differently. Unemployment rate just came out. We came in at 4.3%, which is better than expected. Then we have the aggression index. I want to look at it on a long-term basis here. If we go back to 2020, and we see what happens here where we get a breakdown of the NASDAQ compared to the consumer staples, you can see the break. And this was the beginning of a bear market. Now we're getting a similar break here. It's dramatic. So we want to keep an eye on this particular indicator. It's telling you don't get super aggressive right now. So as we look at it today, you can see here that we've broken down below this particular area, which I would call the line of least resistance, and we've broken down to this area here. So this is a time to consider, just realizing that the market is telling you that we have to be somewhat defensive and not aggressive. However, interest rates are stable. This is the power index, continues to hover around 0% right now. Interest rates for the last 125 days. Now this is using the 5-year Treasury. Interest rates are down 0.77%. So interest rates, if anything, they look very stable, which is a good thing. Now, the small caps are starting to show signs of resilience. Now, if we go back and realize that for the last 3 years, I'm talking 24 and 25 and so far in 26, so 2 and a fraction years, the small cap stocks have been dramatically underperforming the mega cap growth stocks, meaning the Mag 7. But you can see here that we've gotten a golden cross on the moving averages. They're turning up, and we're seeing some major action here that tells us that the small caps are starting to outperform. Now, if we go back and look at historically, you can see how dramatic the drop is. We get a period of outperformance, then it fails, a period of outperformance, then it fails. But this time we've gotten a period of outperformance, a pullback, and then another rally. So it's really not failing. So we want to keep an eye on the small cap stocks. Now the overall trend in both the S&P and the NASDAQ is positive. So we are in a bull market. The primary trend is up. New lows have been above average, above 40 a day, but recently we're seeing some contraction here, so some improvement. This is Bitcoin. Now, Bitcoin tends to track with small cap stocks or growth stocks, but you can see Bitcoin is definitely in a downtrend and is not looking very positive. Now, silver, we're using a point and figure chart on silver. You can see the parabolic rise and the dramatic drop. Now, as I mentioned last week, we want to see some type of consolidation in here, and either it breaks to the upside or it breaks to the downside. But right now, we're just basically seeing consolidation in the silver market. On consumer staples, we're seeing a breakout here in consumer staples, which is telling you very simply that the institutions are out there buying defensive type of stocks. This is not a positive, this is a negative. Now on the overall market, you can see here the NASDAQ has broken down below the moving averages, is trying to rally, but is somewhat failing. So be aware of the fact that the NASDAQ is really not breaking out and making new highs, whereas with the S&P 500, we recently made new highs, we've pulled back, and we're trying to consolidate. So overall, what I would say is that the market is at a transition here. We're starting to spread out. We're starting to see new opportunities that are developing. But right now, I would continue to stay very cautious. The aggression index is telling us to stay cautious. So that's where I would be at this time. If you have any questions, please let